So Oracle shares are moving quite a bit today. What stood out to you from the results?
Yeah, look, I think what stood out to me is what wasn't maybe addressed as much as investors would have liked to see, right? Because numbers were fine, numbers were pretty in line. We can debate if there was a slight miss on OCI and the like, but really, what matters at the end of the day is investors want to know, hey, look, you have these giant commitments from primarily OpenAI as well as others. Now, how are you going to pay for this? And even though they obviously talked a lot about their confidence in maintaining their investment grade rating, in raising capital and being able to meet everything on time, there's still just no answered questions of, okay, have you raised this much debt? Have you done these SPVs, or have you made these strategic deals with outside vendors? And so anything, especially in this environment, in this incredibly fickle market, anything that results in just more uncertainty, or at least doesn't address or add certainty, is going
Huh.
to be punished. And I think this is a kind of seldom used type event, just because there were no concrete answers to that question.
They didn't even really even say how much they needed to raise at the end. They just sort of said analysts are pointing to this $100 billion figure. That's not right. Like it was a little vague.
Yeah, no, it's actually interesting because a lot of us have done the math and said, all right, even if you give them credit for that 30 to 40% AI infrastructure gross margin, where does that end up? And a lot of us have come somewhere, around the 100 billion. My number was a little bit higher than that in terms of the capital they'd have to raise, because I'm probably on the lower end of gross margins. But now they put that number out there, right? And they said it'll be less, if not substantially less than that. But now we're all anchored to that $100 billion number, right?
Hmm.
And
Hmm.
I think there's a lot of assumptions in there. And, I mean, if you think about the level of levers they may have to take on that, I think it's pretty clear they're going to have to look at other options besides just straight debt, whether that's flex financing, SPVs, or, even again, outside investment. I've thrown out the idea of sovereign wealth funds as a potential source of capital, especially, given all the activity that's going on out there, but we just don't know the answer.
Now, they talked about some ways in which they are moderating expenses, or at least ways in which they're protecting against margins falling too low at the outset here. One of the ways they talked about it was they said, hey, customers can bring their own chips, right? We may not have to front the cost entirely. Wouldn't that then impact what they can charge customers and ultimately their own margins?
I think that's exactly right. And one point I've made is with OCI, the reason they're able to get all these deals is almost they're in the right place at the right time and have the right strategic partnerships, right? They built out all this OCI capacity. They had excess capacity at a time where everyone needs it. And then they also have this very key relationship with NVIDIA. Right, where they're a kind of vendor or partner of choice for GPUs when everyone is kind of clamoring for GPU capacity. Now, exactly to your point, if you're bringing your own GPUs or even TPUs, right, does that create a setup where their ability to charge comes down a little bit? And again, what does that do to that long-term OCI revenue and long-term EPS target that they laid out at the analyst day, which was very recent, even if it feels like it was more than a year ago.
Hmm. Now, the other thing they talked about was their ability to lease chips from vendors in some cases. What do you see as the trade-offs with that way of moderating the investment and expenses that they have to put in?
Yeah, look, I think it's a smart decision to kind of figure out, like, are there better ways of financing this, of, like, using lease and the like. And I think this is just a way of saying, how do we just meet that demand as quickly as possible? Because one question I've always had with a lot of these contracts is, are there specific milestones, timelines, ratchets, and provisions on them that if Oracle doesn't meet or get a certain amount of capacity up in a certain time period, does that, revenue maybe not materialize, right? So I think they're using every tool they have in their arsenal to be able to get capacity online as quickly as possible, even if it means doing these sort of, leasing, and the long-term economics probably aren't as good as the other way, but at least it shortens that time frame to getting things online.
But when you talk about the long-term economics, what are the trade-offs that you could see coming from a leasing arrangement?
Yeah, look, I mean, at the end of the day, right? And if they own their own chips, and they're doing it on this 6-year depreciation schedule, and that's a whole other can of worms.
Yeah.
Maybe to talk about at some point. Um, But at that point, like you extract more value out of it, right? Whereas if you're leasing from others, you're actually paying more in rent over time than you
Hmm.
would if you owned it, right? So your long term margins, contribution margins on that will be lower under a lease world versus an own world. But again, if that means that it just speeds up the ability to get capacity online and meet these demands, that's not necessarily a bad thing.
I want to ask you a little bit looking further into the future. So let's say they're able to build out this infrastructure and eventually get to positive gross margins, the 30-40% range that they've talked about. I want to ask you about what Oracle's differentiation strategy is against other cloud vendors, and also broadly all these neo clouds, even as well, that are coming up. I mean, how do these newer, I'm not calling Oracle new, but it's new in the business of that it's trying to build out. How does Oracle look to differentiate itself against the hypers or the big three? How do the neo clouds look to differentiate themselves? Is this just a bet that the market is so big that there will be enough demand for everyone, or is this not going to be a situation where there are winners at the end of the day?
Yeah, look, I'm glad you're asking that question. I think that's a very critical one, and that gets to the crux of, in this environment, why do I favor Microsoft over Oracle, right? But the argument that Oracle and potentially some of the neo clouds would make is they're more suited from an AI architecture perspective for AI workloads, right? They're built GPU first. You think about scale up versus scale out, and how that lends itself here. And I think the bet that they're making is as we get workloads that move from training to inferencing and reasoning, this is fungible architecture that will be able to adapt as a result of that. And the bet that Oracle is making is they have this entire suite of products, right? They obviously have the AI database. They have now this data lake that they have all this data that's already sitting in Oracle database. They have the SaaS applications. The bet they're making is that because they have this AI infrastructure, because they have the GPUs, and the argument they make is it's built in a way that's differentiated from AWS, Azure, and Google, that they're going to be able to benefit from a whole portfolio perspective, right? Because even that 30 to 40% gross margin number that they gave on AI infrastructure, and I would be a little skeptical on their ability to hit that, at least in the near term. But you want this business to do way higher than that in gross margins over time. And the way that happens is if the workloads in AI start to beget workloads in the rest of OCI, starts to beget adoption of database, starts to beget adoption of SaaS, right?
Right.
That's the big bet that Oracle is making. TBD how that plays out.
Great. Well, I think that's a good place to leave it. Rishi, thank you so much for coming on. We appreciate it. That is Rishi Jaluria, managing director at RBC Capital Markets here on TITV.